wherever you're joining us today. We're very happy to have you join this exciting webinar with a great list of speakers. Please excuse the slight delay. I'll jump into it. So we are having this webinar today, Unlocking Financial Potential, Scalable Solutions for Resilient Recovery. And this is a precursor to the World Resilience Recovery Conference technical session that is planned for the 3rd of June. So we would like to collect your input. And first, before we open the discussion, we have different inputs. So the SRSG from UNDRR will give a quick introduction. We have a keynote from Ms. Shakira Mustafa from the Center for Disaster Protection, and then a great panel to discuss some of the results and real-world case studies. If you have questions during the presentations and during the panel, please feel free to put them in the Q&A box, and then we'll move to open up the discussion later. Yes, so as you might have already seen in the notes, there is a webinar that is being recorded. So we're recording the webinar. It started. Feel free to post the questions in the Q&A box. Some of them we might already start answering, and then before we open the discussion later. If there are any tech issues beyond the ones that we just had at the start, please try maybe to check in again later. With that, and without further ado, I would want to welcome Mr. Kamal Kishore, who is the Special Representative of the UN Secretary General for Disaster Risk Reduction. He is also the head of the United Nations Office for Disaster Risk Reduction. Mr. Kishore has nearly 3 decades of experience in disaster risk reduction, climate action, and sustainable development at the global, national, and local level, having worked at government, the UN, and with civil society organizations. So please, Kamal, over to you for the opening remarks.
Thank you very much, Senya, and thank you everyone for joining this very important webinar, which is a curtain raiser to the World Conference on Resilient Recovery, which is a preparatory event to the 8th session of the global platform to be held in June here in Geneva in the first week. I quickly want to jump into the topic. I know there's a keynote address right after this, so I'm looking forward to hearing the views of Ms. Mustafa. But what I wanted to say was that, we talk about humanitarian appeals after major disasters being underfunded. If humanitarian appeals for supporting immediate response are underfunded, then appeals for supporting recovery and reconstruction are severely underfunded. So to just give you an example, on 17th of December 2024, Vanuatu had an earthquake measuring 6.3 or 6.4 magnitude, and huge losses, and the assessed damage and losses were at $200 million, which is about 20% of their GDP. And as of 17th March, they had, a total pledges of only $40 million, so less than 20% of the recovery and reconstruction cost was funded. There are some exceptions. We have the example of 2015 Nepal earthquake, which was recovery was reasonably well funded. We have, of course, the example of Indian Ocean tsunami of 2004, which was also extremely well funded. So large disasters that attract global headlines have often attracted funding, but it is more of an exception than a rule that recovery and reconstruction programs are hugely underfunded. Now, what are some of the things that we need to look at? Of course, Shakira's presentation will address that, but I just want to highlight three things that need to happen. The first thing is that it's really important that national governments begin to put in place national systems for funding recovery. It is not just funding for response, it's not just funding for risk reduction. You need a pot of money for funding risk post-disaster recovery in a very predictable way. Some countries, such as India, have begun to put that system in place with a sizable amount of resources to support recovery and reconstruction. And I know Mr. Sanjeev Jindal from the Government of India is here and he will talk about it. But most countries do not yet have a system of funding post-disaster recovery. Now that could be a national system which has resources from national budgets. You know, there could be some arrangement with IFIs in terms of catastrophic drawdown facilities. There could be insurance. There could be a range of solutions, but there is no substitute to having a national system. The second thing is that a lot of the times when you look at the bill for recovery after an event of whatever magnitude, it scares away the potential financiers because we look at the aggregate and we do not take into account the fact that this is really a multi-year thing. So if you look at post-earthquake recovery in Vanuatu, yes, the bill is $200 million, but it will take at least 4 years to complete that. So on an average, you're talking about $50 million per year. And when you have that kind of allocation, you can also begin to see how you do a more deliberate exercise of recovery, well-planned recovery, so that you actually build back better. That's the second thing I would say. The third thing I would say is that it is really important to see how we can achieve some sort of convergence between various streams of funding and not just look at recovery funding in isolation. There is a lot of development, infrastructure, improvement funding, which is pre-allocated even before a disaster. How do you reprogram all of that in the aftermath of a disaster so that it all converges and it begins to address the problems of address the recovery needs of the affected people and helps us take forward helps us move forward on resilient recovery. I think with these 3 points, the first that no substitute to a national system. Number two, take a multi-year horizon. Number three, converge different streams of funding. I would like to close here, but I think this webinar is really important. I hope there will be a think piece which will come out of it, which will then inform the World Resilient Recovery Conference, and we can begin to sort of advocate with the governments to begin to action on all of these things. We should be talking about financing recovery not after a disaster has already occurred, but even before that, because these things are not abnormal. They happen with regular frequency, and there's no reason why we should not have a predictable system to address the financing needs of recovery. Thank you very much. Back to you, Sanya.
Thank you very much, Kamal, for this introduction and for setting the stage. And with that, I would like to introduce our keynote speaker, Shakira Mustafa. She is the research lead at the Center for Disaster Protection. She's a recognized development and public finance expert with an expertise across a range of topics in public finance, different public finance issues, so including debt management and government expenditure. And she has advised in multiple countries on public financial management. So over to you, Shakira, to give us an introduction on topic in general on recovery financing before we move to the discussion. Thanks.
Thank you, Sinja, and thank you, Kamal. Let me see if I could share my screen with minimal issues. Entire screen. Oops. Can you see that? And I'm going to put it on slideshow.
Yes.
Should I try to minimize you at the end?
It's fine. We can see on full screen.
Okay. So jumping straight into it, don't know how to. Disaster risk reduction finance, disaster risk finance, contingent loans and grants, adaptation finance, early recovery finance, reconstruction finance. I'm sure most of you on today's call are familiar with these terms, while some terms may be less familiar than others. This is to be expected. Most of these terms lack clear, universally agreed definitions. As a result, I often find myself in conversations with different experts who use different words to mean this to describe the same thing, or who use the same word to mean very different things. This lack of a common language is problematic for two reasons. First, it can result in miscommunication. Usually when you have an expert who is using a specific term, they assume they're adding more precision to the conversation. But in reality, what can happen is that it can actually create more misunderstandings. Secondly, it can create barriers between people and inhibit collaboration. For example, some people don't realize that financing for responding to impacts could actually be linked to activities for reducing the risk even before the event occurs. My name is Shakira Mustafa. Today, I'll be focusing on breaking down these barriers by exploring how these different types of financing fit together. I'll be sharing what I've learned over the past 10 years, engaging with governments as well as different providers of financing, particularly the multilateral development banks, climate funds, and the insurance industry. I'll begin by briefly discussing a conceptual framework that brings these different puzzle pieces together into something that's more cohesive than is currently shown on the slide, and then quickly move from theory to the real world. So, sorry, not sure. Conceptual. There seems to be a technical issue. Apologies. So the conceptual framework, how do you fit these different pieces together, particularly the type of financing? For me, the first step is to ask two related questions. What is the purpose of financing? And where does that purpose fit in the timeline? In this diagram, this vertical dashed red line differentiates between the impact. So to the left of that is financing to reduce the impact. And to the right of that line is financing to respond to the impact. So of course, the left is the things that we're familiar with of risk reduction and adaptation finance. Things like building more resilient infrastructure, and to prevent and reduce disaster risk, as well as to reduce the impacts of things like climate change. So on the right-hand side, in the darker orange color, we have financing to address the impact after the disaster happens. So that's financing for disaster response and relief, which are basically actions taken during or immediately after an event to save lives, to reduce the health impact, to ensure public safety. So things like emergency food or medical supplies. Then a little bit along the timeline, there's financing for early recovery, which is more restoration of basic services, shelter and governance. And even further along the timeline after the event, we have financing for longer term reconstruction. And that's financing to rebuild and restore critical infrastructure, facilities and livelihoods that's required for the full functioning of a community or society after a disaster event. The key point I want to make is that despite this financing being after the event occurs, that financing, as Kamal said, can be pre-arranged. If you get into a car accident, you can't expect coverage from an insurance policy if you didn't buy it before the accident. That is the logic of pre-arranged financing. Today, we'll be focusing on the rest of my presentation will be focusing on the rationale of pre-arranged financing, the instruments, as well as the track record to date. So what is pre-arranged financing? It's financing agreed in advance of a shock that is guaranteed to be released when pre-agreed triggers are met. That means the money is available more quickly and can move faster to where it's needed. There is sometimes this perception that when we talk about pre-arranged financing, we are talking about insurance. Yes, insurance is part of it, but it's only one part of it. Actually, if you look at the internationally supported instruments that most governments use in lower middle income countries. Most of that pre-arranged financing is in the form of contingent disaster loans and grants from the multilateral development banks rather than insurance. A point I want to make is that this idea of arranging financing ahead of disasters, it's in the spotlight in a way that it has never been before. It's been rising up the agenda over the last 5 years through various high-profile initiatives, such as the Bridgetown Initiative launched by the Honorable Prime Minister of Barbados, Mia Mottley, in 2022. It's part of the Global Shield Against Climate Risk. It explicitly is seeking to help countries accelerate the scaling up of pre-arranged financing using a country-led process. It's part of an initiative for the V20, which is a group of the 68 most systematically vulnerable countries in the world. It's also feeding into the MDB reforms themselves. Last year, the World Bank unveiled its new crisis response toolkit, crisis financing toolkit. And of course, the other MDBs are in the process of doing similar reforms. So that's why things like climate resilient debt clauses, pre-arranged financing is in the spotlight, it is a priority. Why? It is a recognition that disasters are becoming more frequent and costly, and that a large number of countries are ill-equipped to cope with this new reality. And also that the recognition that if we maintain the status quo of reacting rather than being proactive, disasters will wreak havoc on lives, livelihoods, economies, and ecosystems. So moving on to the realities of pre-arranged financing. For the rest of this presentation, I draw heavily on 2 flagship reports that the Center produced in November last year. The State of Pre-Arranged Financing, which is basically tracking the numbers and estimating the quantum of pre-arranged financing that currently exists in the international system. And the second one is a stock take that I led at the center, which is basically a stock take of the main instruments that the international financial institutions currently offer. In this stock take, I basically differentiate between 2 types of pre-arranged financing. So the first type is risk retention. When a government retains the risk, it essentially has to pay for the full amount that's triggered. So, if a government takes a contingent disaster loan, it has to repay that loan. If it triggers a climate resilient debt clause, yes, they have a deferral, but they have to repay that deferred amount. The next level is risk transfer. And it's basically for a fee, the government is putting that risk to a third party who is now on the hook for providing a certain amount of money if the event happens. So of course, that's things like catastrophe insurance as well as cat bonds. So reality 1. In our State of Path report, we showed and we found that a very, very small proportion of the international crisis financing system, a very small portion of the financing is pre-arranged. This slide shows the total quantum of international development finance, then what portion of that goes towards crisis financing, and that very, very small orange dot is how much is pre-arranged. In the years between 2017 and 2022, it never exceeded 3% of that crisis financing. Only 3% or less of crisis financing is pre-arranged. Reality 2 is, yes, it's small, but the good news is that most of the instruments provide timely liquidity. They're super quick in getting money into government hands after the pre-agreed triggers are met and the country requests that disbursement. Of course, fast disbursement is extremely important because it safeguards lives, but it also reduces the response cost and play a critical role in minimizing the health and economic inequalities. So in the case of the MDBs, usually that money is disbursed within a few days of a country request. I found examples when I was looking at the response time that sometimes it was within 48 hours of the disaster event. The regional risk pools, so we have the Caribbean one, CRIF, and there's a Pacific one, PCRIC. They have targets of within 14 days and within 30 days, and they generally also meet their targets and do that usually faster. There are some mixed results for some of the other instruments, particularly the World Bank issued cat bonds for tropical cyclones and the drought payouts from the Africa Risk Capacity, which is the risk pool for Africa. And that's related to issues sometimes with the calculation and the verification process to assess if the trigger was met. So in the case of Mexico, there have been two tropical cyclone events where the country waited about 4 to 6 months after the event to receive confirmation that, okay, yes, the bond was triggered and they'll get a payout. So what's really key here is that countries understand their trigger design and the decision-making process and the potential sources of delay, so that to see how that affects their ability to use this for timely liquidity. And of course, some of these things can be improved and have improved over the years. Reality 3 that I really want to emphasize as a PFM person is that importance of preparedness and the readiness of the entire system to act. There is a tendency sometimes in these conversations to focus on designing and choosing instruments to get money quickly into government hands and much less focus on what happens after you get the money. I have worked in government and with governments for several years, and the reality is that some governments, they struggle to spend efficiently and effectively in normal times when there's no disaster. And you really see that if you compare their planned expenditure and their actual expenditure, particularly for large infrastructure capital investment projects. Usually there's long delays and usually there's an underspending sometimes in the initial years. This is even more challenging, as you can imagine, for when there's a disaster event. When we talk about path, we need to understand, do governments have the systems and institutions in place to use that money effectively? Be it whether it's early action, recovery, or reconstruction. If they do not, it is highly unlikely that the full benefits of pre-arranged financing would be realized. In some cases, delays may actually undermine that value for money of these instruments. The good news is that different providers are recognizing this importance of preparedness, including the MDBs. In fact, the main contingent disaster loans and grants from the Asian Development Bank, from the Inter-American Development Bank, and from the World Bank, they are accompanied by a mandatory program of policy actions that generally seek to improve a country's disaster risk management capacities. For example, in some countries, the policy actions require that the country develops emergency plans and emergency drills, that they strengthen their PFM systems, in the sense that they have emergency procurement rules in place and that they have systems for tracking post-disaster spending. Having quick money in is of limited benefit if that money cannot be timely transferred to the relevant institutions and to shock-affected communities. Reality 4. Pre-arranged financing can help to build wider resilience, even when it's not triggered. So I just want to briefly give 2 examples. The first one is the Mexico's National Disaster Fund, FONDEN, which was recreated in 1996, but was closed in 2021. FONDEN is a really great example because it had this reconstruction bucket, and it was partly funded using a mix of the government's federal budget, as well as a combination of risk transfer instruments like insurance, like cat bonds. That reconstruction bucket had a rule that 25% of the proceeds had to go towards building back better during reconstruction. In addition, there are various case studies that show that this was done in the states of Tabasco and the state of Nuevo Leon, that the building back better reduced the subsequent damages and losses from future events, from subsequent events. The policy actions, so example 2, the policy actions of multilateral development banks that I mentioned previously, they also tend to have a very risk reduction flavor in terms of requiring countries to identify their risk and to reduce risk and resilient reconstruction. So in the case of Dominican Republic, their CAT DDO from the World Bank requires that 15% of public schools conduct a disaster risk assessment, and that a certain proportion of the schools are included in a rehabilitation and retrofitting program. In Nepal, there is a policy action requiring that government buildings comply with new technical seismic resistant criteria that was included in updated Nepal National Building Code. Just remember, this is financing that was put in place to respond to future disasters, but even without triggering, they can incentivize activities to reduce risk. There's a bit of a challenge in terms of measuring the impacts of these actions, and there's a tendency to focus on the outputs and processes rather than whether it helped to reduce exposure and vulnerability. Reality 5, just to briefly say that there is no single best type of financing or instrument. What works, what type and what combination works will vary by countries, and it depends on the risk profile of the country, the level of protection they're seeking, their objective, their fiscal space. So I just want to really highlight the importance of there's no one size fits all. So just in my last minute, just to highlight 3 areas of improvement. In our report, we identified areas of good practice that are emerging. But in terms of areas of improvement, these are the 3 ones that countries, governments need a coherent and comprehensive approach that brings together the different types of financing and actors. And that approach needs to be nationally led and owned. From my experience, disaster risk financing strategies tend to be developed by the Ministry of Finance, while things like national adaptation plans or risk reduction plans are led by other ministries. And sometimes there's this fragmentation and the silo and a lack of integration. We need to do better in that. Second, we need governments and their development partners need to ensure that system and processes are in place to use financing effectively and efficiently. And last but not least, we need to strengthen the evidence base of what is working and what needs to be improved for development objectives to be achieved. This requires more independent evaluations as well as better M&E frameworks without putting too much of a burden on the countries themselves. Thank you for your time.
Thank you very much, Shakira, for this introduction. You already mentioned some case studies and examples and explained a bit better the different instruments. Before we move to the discussion, just a quick note again to everyone. If you have questions, please use the Q&A. I see some of you have started doing so. So colleagues will start responding, and then later we'll also address some in the forum. But with that, we'll move to the next 30 minutes for the input from our different panelists, where we will get also case studies from countries, UN perspective, as well as the private sector perspective. I would like to start first one to introduce Mr. Sri Sanjeev Kumar Jindal, who works with the Disaster Management Division in the Ministry of Home Affairs of India. He heads the Disaster Management and Police Modernization divisions, focusing on disaster risk reduction and institutional development. And that includes the NDRF Academy and Coalition on Disaster Resilient Infrastructure. He also has experience serving on the boards of several national financial organizations. Very warm welcome to you. And I would like to start with 3 questions to you. Can you share with us steps that the government of India has taken to strategically plan and implement recovery financing? And then also, which financial instruments did you find most effective in addressing immediate recovery needs? And then lastly, how are you measuring the impact sort of on the long-term resilience and sustainability? Thank you. You're on mute. Still on mute. Can we maybe unmute? Otherwise, we'll try to unmute you from the back end. I see you're sharing a screen. We see a blue screen. Okay. Just give us a minute. Trying to unmute you. We can't hear you yet. If we continue to have issues, we might move on to our next panelist and try again later. Let's see. Very sorry. Give us a few seconds. We're still trying to unmute you.
Am I audible now?
Yes. Yes, there's an echo, but we can hear you. Yep.
Sorry, there was some problem in the system, so I joined from the other system.
We do hear an echo, but we do hear you. It seems there might be two accounts connected, which is causing the issue. Ah. Okay, maybe in the interest of time, sorry for this. We'll move on to Jaime Ramon, and we'll move back to
Yeah, it's
Mr.
okay now?
Juno. Okay, yes, we see you well now and we hear you. Over to you. Sorry.
Thank you, Sinja, and thank you, Mr. Kamal Kishore, for setting the stage in motion. So, whatever the principles are stated by Mr. Kamal Kishore and Shakira, so our country, India, is following up the all those issues, and as well said, that is a well-defined structure of disaster risk financing is critical to support resilient recovery. And this is evident from the COVID-19 experience to have a system which can respond to large-scale emergencies. Talking about India, that the first part which Mr. Kamal Kishore mentioned about national government to put in place for recovery prediction. So we have a legally mandated national and state disaster risk management funds, which are mandated under our Disaster Management Act. We have two-tier fund allocation, one at the national level and the other at the state level. And whenever the state governments are short of funds, then additional sources are given from the national fund. And we have a system of disaster financing through multilateral assistance also, whenever there is a need for diversification. Coming to the predictable source of financing, we have an independent system of finance commission which assess the requirement in the coming 5-year period, and they make an envelope of allocation at the national and state level. And allocations are made for a period of 5 years. So the state government at the ground level are aware that what are the resources they are going to have in the coming period. And whenever there is any disaster, the resources are put in place, covering all phases which Shakira has mentioned, the pre-disaster as well as post-disaster. So we have the system for preparedness, capacity building, early warning system, response and recovery, and then immediate recovery as well as the reconstruction phase. Different funds are there. So to reduce the dependence upon multilateral agencies, we have now a substantial fund allocation. The total size is $30 billion, which cover the response and relief to the extent of 40%, 12 billion, and 9 billion for recovery and reconstruction, and 6 billion for mitigation as well. And we are also exploring the feasibility of setting up a diversified risk pool covering various kinds of hazards, as have been discussed earlier. So we have proactive disaster management financing covering all phases of disaster risk cycle. There are dedicated allocation to different disaster phases. We have predetermined funds. Allocations are made at the beginning of the year, and resources are released in advance to the states so that they are not short of fund when there is a disaster. States have the autonomy to spend the funds as per the norms fixed by the national government. And as I mentioned, there is a 5-year cycle, and these funds don't lapse. Like if in case there is no disaster during any financial year, so the funds get accumulated with the state government in the special fund, which is the disaster risk management fund. So the funds don't lapse, and they can be used in the subsequent year in case you have a bigger calamity. The system works like this, that we have a transparent system of guidelines and norms fixed, which are applicable across the country. And there is predetermined allocation, as I mentioned. And after any disaster, we have two-stage system of fund dispersal. First is the immediate recovery, assistance given to the affected families, as well as the restoration of the damaged infrastructure. Thereafter, a detailed post-disaster need assessment is done, where all the sectors are studied. There is a multi-sectoral teams are there, experts from different sectors, and a detailed recovery and reconstruction plan is finalized with the various levels of appraisals at different stages. And thereafter, these are implemented with a multi-year approach on the build back principle. If we talk about previous experience, we have a Latur earthquake of 1993, Orissa super cyclone of 1999, Bhuj earthquake of 2001, tsunami of 2004, Uttarakhand cloudburst of 2013, Kerala floods 2018, and recently we have land subsidence in Joshimath in 2023. In these big disasters, recovery and reconstruction have been implemented. And if we talk about the learnings through these various plans, this is social economic recovery, which focus on social infrastructure, resilient infrastructure, and productive livelihoods. Focus in rebuilding of assets, hazard resilient construction, capacity building for government and various stakeholders involved. The approach is basically community involvement and owner-driven approach, and also the various plans have been benefited by technical expertise from multilateral agencies. Coming to the issues, challenges which are being faced, it's not an easy road. It requires multi-year engagement with various stakeholders. Apart from financial resources, we need technical expertise, which is very critical for preparing the plan in terms of the assessment as well as how the various sectors can be covered. There are complexities involved in assessing the livelihood support, like which are the sector to be covered, which are the people to be covered. Is it the assistance to the individual or to support a long-term livelihood support? And it is also important to synergize various ongoing development activities. So like we have ongoing plans for the building rural houses, schools, hospitals, roads, various government schemes are there. And we try to converge various resources into these schemes under the recovery plan. So if we talk about the resources envelope of $30 billion, if we take the convergence, the envelope becomes much bigger. And it's important for various countries where they face multi-year continuous disaster like droughts and floods. So like if flood, one recovery plan is made and next year again the same area faces a flood, then there are challenges how to differentiate the different recovery plan of one event and the second event, and implementing the plan during when the ongoing plan is going and there is a second event of floods occurring. Thirdly, I come to the point of outcome, and we are trying to establish a robust outcome framework. The work is in progress. Apart from the financial scrutiny, which is done by our independent auditors, which are established in the Constitution. We are also going for outcome-based approach, which is a work in progress. And based on that, we can assess that how the recovery plans are implemented. So talking about the instrument, we don't have such instrument here. It's a national predetermined with the legal backing resources are allocated, which are independent of budget allocation every year. So it's a predetermined and allocation is made to the states in advance so that they can utilize it whenever there is a event of disaster. Thank you for your kind attention.
Thank you very much for that input. Giving the example of India and also speaking to the 3 points that Kamal mentioned at the beginning, and the importance of having national strategies to have a multi-year perspective and also to converge different funding streams. With that, I thank you very much. I would move on now to our second speaker, Jaime Ramon, who is a senior advisor in the Sustainable Finance Office within the Ministry of Finance of Chile. He brings deep expertise in climate finance, natural capital, and regulatory policy, advising on strategies to align financial flows in environmental goals. Mr. Tremont also serves on the board of the Green Climate Fund and contributes to international climate finance negotiations and disaster risk financing. Welcome. And the question to you is, Chile has faced a series of high-intensity disasters over the last years, in recent years, devastating wildfires in addition to extreme weather events that have impacted large parts of the country, unfortunately. So what would you say are the main lessons that you can draw from in terms of planning, in terms of coordination, but of course, above all, on financing for recovery and reconstruction after these events?
Many thanks, Sinja, for this invitation, Kamal, and also congratulations, Shakira, for your very good and clear presentation. So it's an honor for me and to share the Chile's experience, especially from the perspective of public finance in the context of disaster resilience and recovery. So I would like to begin by providing some context that I think is necessary to understand. So as some of you know, Chile is a country with geography as diverse as it is challenging, from the driest desert in the north to volcanic zones and a long Pacific coastline. We live with constant exposure to natural hazards. Earthquakes, tsunamis, wildfires, and extreme weather are not exceptions. They are part of the recent history. And their increasing frequency has tested not only our emergency response capability, but also the strength of financial and institutional systems. So one of the clearest lessons we've learned in this is we need flexible and anticipatory financial tools that allow us to respond with agility and sustain recovery over time. So that is the very brief context. And with that in mind, in 2024, Chile created the Transitory Emergency Fund with a capacity of up to 800 billion peso, which is approximately 900 million of US dollars. And this fund allows us to finance reconstruction efforts from housing to basic infrastructure. And this is the important part. So this is without being subject to the constraints of the annual budget cycle. So what makes it particularly interesting in its financial model. So the fund is supported by public treasury assets, enhanced by temporary tax measures, and then strengthened through private donations, incentivized through tax benefits. So one of the key elements is the substitute final tax, which allows taxpayers to voluntarily advance tax payments on retained earnings at a preferential rate. Additionally, this architecture is complemented by the National Reconstruction Fund, which was created after the 2010 earthquake that we faced, and this was recently strengthened by law. So this fund enables private donations with clear tax incentives and allows projects to be executed not only by the state, but also by donors and non-profit organizations with proven experience. So spending from both funds can be executed through existing public programs, specific laws, an agreement with municipalities, so this is the local level, and civil society organizations promoting a territorial and collaborative approach. This emergency fund is managed by the Ministry of Finance, particularly on one specific office, and includes legal provisions for transparency and reporting. In parallel, and this was part of the discussion that we were hearing, we were listening to, Chile has advanced in pre-arranged financial instruments. So one example is the issuance of a cat bond or catastrophe bonds. And the first one was in 2018. This was a jointly effort from the Pacific Alliance. We see it is composed by countries. It is Mexico, Colombia, Peru, and Chile. And the second in 2023, supported by the World Bank. So the latter provides coverage of up to 630 millions of US dollars for both earthquakes or tsunamis, and triggered automatically when specific technical parameters are met. So in very simple terms, the state or the republic issues a bond, investor purchase it, and if a major disaster occurs, hopefully not, those funds are transferred to the country. If not, investors receive their principal plus interest. So this is the way to secure immediate liquidity without waiting for reimbursement or resorting to debt afterward. While this fund has not been yet been triggered, it represents a concrete tool to fiscal protection. And this final instrument has been essential, but has the collaboration with the private sector, while centralized reconstruction fund from 2010 was not reactivated. Partnerships with NGOs played a relevant role in channeling private resources toward priority recovery efforts. However, private contributions managed through state mechanisms have declined, influenced by the tired economic conditions, the emergence of direct donation platforms, and the shift in institutional trust. So also plays a role or explains a lot of this. So this calls for rethinking fiscal and regulatory incentives to strengthen sustainable public-private cooperation in disaster financing. And as a final reflection, and I'm finalizing here, in countries like Chile, where risk is part of the geography, it is not enough to react well, so we must be prepared before the emergency strikes. Having well-designed funds, anticipatory financing, and genuine public-private collaborations enables timely, efficient, and legitimate action. And these are my final words. Resilience is not built during a disaster, it is built long before through fiscal foresight and political will. So thank you very much.
Thank you very much for also giving the perspective from Chile, and with that another national example. With that, having the examples from India and Chile, we're now moving on to Dr. Babatunde Ahonsi, who is the UN resident coordinator in Turkey. And thank you very much for joining us today. As a national of Nigeria, Dr. Ahonsi has more than 25 years of experience in international development. He has served as the UN resident coordinator also in Sierra Leone and China, and has a background in population studies. So the question to you now, moving from the national level, is the UN does play a key role in facilitating and financing disaster recovery. including through, for example, coordinated needs assessments. So can you share the experience of the UN in supporting financing for recovery after the 2023 earthquake that happened in Turkey? And how did you ensure the coordination amongst relevant actors, including the local communities that have been affected?
Thank you, Sinja, and I'm grateful for this opportunity to share some perspectives from Turkey in terms of how the UN collaborated with the government and several stakeholders to help leverage the kind of financing that was required and continues to be required to really drive the recovery efforts to get Turkey to build back better. In terms of background, the twin earthquakes in February 2023 were unprecedented in terms of their magnitude and coverage in the recent history of Turkey. 11 provinces affected, major devastation across those provinces, claimed more than 50,000 lives, wreak damage on over 500,000 buildings. So what did the UN do in that context? There are 5 aspects, just to summarize. The first of the aspects to our engagement was the immediate response and needs assessment, which the UN led in collaboration with the government, the World Bank, and the EU. And that assessment provided a strategic framework for financing and recovery planning. The UN also, of course, led a $1 billion flash appeal to mobilize resources for the immediate emergency response and early recovery. And as the UN country team itself, we accessed $10 million through the Central Emergency Response Fund to basically address prioritized life-saving interventions. The second aspect, which is more focused on recovery, was the effort that the UN led in mobilizing international financial support by co-hosting a high-level donors conference alongside the EU and Sweden in Brussels in March of 2023. That initiative secured 7 billion euros in financial commitments, both for Turkey and Syria. And a lot of that funding has gone into reconstruction of critical infrastructure, support for social protection, and building the capacity of local governments, the municipalities, to really drive both preparedness and recovery. In all of this, we've collaborated extensively with international financial institutions, midwifing conversations and partnerships with the government in trying to ensure that there was adequate financing, especially through public-private partnerships. We are lucky that in Turkey, we do have a very active global compact network. And through this, the UN facilitated dialogues between governmental agency and private investors to fund infrastructure recovery and service delivery improvements. The third aspect of what we did was really as terrible as this disaster was, it was an opportunity for us to really advance the Nexus approach to recovery. So in July of 2023, the UN country team in Turkey, in consultation with its partners, prepared a recovery framework, which informed our adoption of a humanitarian development nexus approach to enable us to transition, enable everyone to transition from emergency aid to long-term resilience building. On our part, we modeled integrated programming by trying to coordinate and align what we're doing in humanitarian aid with livelihood restoration and infrastructure rebuilding. The key interventions were really around job creation and medium, small, and micro enterprises recovery, a lot of work on social cohesion and inclusion, because the earthquake affected areas also happen to host millions of refugees, especially from Syria. That Nexus approach also enabled us to build the capacity of the municipalities and local communities around disaster risk management and financial planning, as well as inclusive planning using digital tools. The fourth aspect of what we did that I think I would like to share with everyone is really the development and rollout of an area-based coordination for inclusive recovery. Of course, once there's a major disaster like that, the UN deploys OCHA. We don't have an OCHA team here to lead the emergency response, but that is for a very short period, 3 months. Once they are gone, what then takes over that? What is then the follow-up mechanism for coordinating early recovery and medium-term to long-term recovery and reconstruction? So the UN very quickly transitioned from the emergency response mechanisms to create first a UNCT+, a coordination platform that brought the UN and non-UN partners together, including international NGOs, national NGOs, local authorities, municipalities, and other groups to plan together efforts at advancing the recovery. Given that the earthquake was centered in the southeast, we created an area-based. Out of that, we created an area-based coordination team in Gaziantep, the biggest city in the southeast, and we established an intersectoral coordination mechanism that facilitated the integration of humanitarian development and recovery approaches, both in the short to address short-term needs and long-term recovery needs. As I speak, over the last 5 months, we've transitioned the area-based coordination platform to the Southeast Turkey Intersectoral Coordination Group. This is in recognition of the need for a long-term development-focused coordination mechanism that will help to drive the rest of the recovery and reconstruction process. Finally, I want to emphasize that UN partnerships for sustainable recovery financing has really been anchored on 2 key elements. Of course, the biggest player in recovery is and continues to be the government of Turkey. Our role has really been to co-travel with and provide additional source of technical and financial resources, primarily through private sector engagement, and 2, support to municipalities. So in summary, I would think the key words for me are really localization, building local capacity, and capacitating the communities and municipalities. And secondly, through partnerships, enabling the deployment of innovative financing for recovery. I thank you.
Thank you very much for that input on for describing with the example of the earthquake in Turkey and Syria. Now we have had inputs from national level, the UN broader perspective. We're now moving to our last panelist. So welcome Kip Courier-Koske, who is the Director of the Strategic Partnerships and Policy at the Insurance Development Forum. We'll now have more the perspective of the private sector. So Mr. Koske has extensive experience in financial and disaster risk management, debt underwriting, and country risk assessments from a range of different global and regional financial institutions. So the question to you is, how can the private sector collaborate, or the private insurance sector collaborate with governments to enhance financial readiness and risk management frameworks? And how do you think specifically what steps can be taken to better integrate insurance solutions into national disaster recovery strategies?
Thank you, Sinja. I hope you can hear me.
Yes.
Perfect. As Sinja mentioned, my name is Kip Korikoski. I'm a Director of Policy and Partnerships at the Insurance Development Forum. I'm pleased to be at this important convening and listening to my fellow panelists, and some of the examples they mentioned are really hitting home in terms of some of the risks that people are facing and some of the key considerations that we need to have when we're looking at this. And I think the examples not only highlight that this is not only a theoretical exercise, that there's people and vulnerable societies out there that are trying to figure out how to sort of handle this. I come at this from a private sector angle, although I do not represent the private sector directly, and I'm a part of a forum. I think it's important to sort of highlight that the private sector is part of this sort of whole of society sort of approach. It's important to also recognize that we have shared goals, both as private sector and also from a public sector perspective. Similarly to governments and other actors and other communities, we're dealing with uncertainty across the board, across society and across sort of businesses as we look across these various challenges that we face. I think Shakira mentioned there's only $0.9 billion of financing that was prearranged. I think if you contrast this number with what the insurance industry specifically pays out on an annual basis due to natural disasters, not other claims such as motor or any other things, disasters purely driven by weather risks. So we look at thunderstorms, hail, floods, droughts. The number is actually 100 billion globally. So that number is significant. And when you look at the funds that Jaime and my colleague from UNDP sort of mentioned, that could be significant and also sort of support some of that work. So what's the divergent view here, and why is private sector, and that most of the money sort of goes to private hands and sort of is located in developed countries? And why is there sort of a divergent in sort of looking at this risk? I think importantly, we view, I think from a public and a private perspective, risk management is sort of viewed as from a business planning and strategy perspective as an opportunity. So what we're trading in is we're trading uncertainty for opportunity. I think by defining key risks and setting standards, we generate critical information that fuels informed decision-making. This is used across the board when we look at chief risk officers reporting to their shareholders, but also from a CEO perspective. And I think such similar sort of designs should be put in place in the public sector, specifically in governments and other large public sector institutions that sort of report upwards. So you see where you have what's uncertain and how do we sort of translate that into some sort of opportunity. Obviously, this is not sort of distributed equally. And this is why sort of insurance comes in as a potential equalizer, not the only one, as fellow panelists have also mentioned. I think what we need to sort of give the general public and society across is sort of how do we equalize this access to these opportunities that are out there? I think insurance, through its core principles of risk sharing or burden sharing, acts such as an equalizer. But then you have certain sort of existing instruments such as social protections programs. How do we scale that up? How do we make them more reactive and better placed to sort of react to those aspects? I think what helps in that process is defining process that relies on discipline and analysis, and that again drills into the data aspects of this, and also trust in the frameworks that are used. I think this is how we grow systems, products, and facilities to support the most vulnerable. Just looking at the example that was just given by my previous panelists, like in Turkey when the earthquake hit, I think where you sit there, you have a public-private partnership headed by the government and supported by the government, but supported equally by the private sector. And I think when the earthquake struck, there was over $100 billion worth of damage. the insurance paid out around $6 to $7 billion, which was sort of insured. And you can see that there's a huge gap, and we need significantly more instruments, more tools to sort of help respond to that. But importantly, and as what the keynote speaker mentioned, it was the speed of the response. So I think within 24 hours, there was around almost $300 to $400 million on the ground, sort of supporting some of that work. So what made it sort of work? What made it work? So importantly, as I mentioned, it's this public-private partnership. There's a need to sort of co-develop national or regional disaster insurance pools or schemes, potentially targeting specific vulnerabilities, because there's significant amount of vulnerabilities out there. Can we be very precise and target what exactly makes sense for a particular society and sort of build that out from there? Secondly, and I'll focus on this in terms of the data and analytics piece of things, there is sort of a lack of data in terms of from a financial perspective. And how do we get risk modeling and data to inform public assessments and land use planning, for example, in Turkey, where you're clearly affected by earthquakes? If you look at that, insurers have all this data, they have a lot of analytics, they have a lot of support, but we need to sort of come together, use this data together to sort of inform some of this public risk assessment. I know we're running out of time, so I'll skip a few points. The third one, and I think one thing that I think Kamal sort of mentioned, is sort of how do we incentivize risk reduction incentives? And essentially working with insurance, not as a stick, but as a carrot, sort of how do we adopt risk reduction measures to reduce the price that's paid in terms of premiums? And that leads to some sort of discipline when people are looking at building certain buildings somewhere, or allocating resources to build a certain infrastructure. If there is an incentive to reduce that risk, financially, monetarily, how do we sort of make that work? And lastly, and I think everybody's spoken about this, is capacity building. I would close by just saying that I don't think we expect perfect solutions. There's no comprehensive solutions from day one. I think the key is to start the collaboration and evolve the frameworks over time. I think we need a whole of society approach, combining government frameworks, private insurance mechanisms, and community action as an example. And also, I think what we tend to do when we look at these schemes, or we look at setting up potentially this, is sort of we're scared of failure. And I think that's counterintuitive to what we're looking to do here. I think what we need to do is sort of put failure or some setbacks as part of the success, because we learn through those setbacks and sort of fail forward and build more effective and resilient systems. So collaboration is key. Use of PPPs and risk reduction incentives were my sort of final points. So thank you, Sanjay, and apologies for potentially running out of time.
No, thank you very much, and appreciate looking to the time. Yeah. Thanks to all the panelists for your inputs. I see there have already been quite some questions asked and responded to in the Q&A. We're a bit over time, but we do have more than 10 minutes now, minimum to proceed with the Q&A. So one of the ones that was partly responded to, but I think that maybe is interesting for all panelists, was one question that was asked on how can we better coordinate with government authorities for financing to also reach the community-based organizations for the support of affected populations. And there, I think Jaime gave an example also from Chile already on the involvement also of non-governmental organizations. Of course, Kip talked about the involvement of the private sector. I don't know who of the panelists would maybe want to respond or take a step to share some thoughts on, this involvement between government authorities and then also reaching and collaborating with community-based organizations in making recovery financing work. And maybe I'd like to ask all the panelists to, for the Q&A session, turn on their videos. You can directly indicate. But Shakira, to you first.
Thanks, Insho. So I briefly reply to that in the sense that we tend to focus on the financing and, just putting these instruments in place and, and getting that money. But there is a lot of things that accompanies that financing in some cases, and that's that planning and element about, you have to identify the risk.
Oh.
You have to know what the options on the table, who are the different stakeholders involved. And it's a process, right? And that process should be as inclusive as possible. Some external actors try to influence that, but at the end of the day, it is the government. It is a sovereign body, and it depends on them having the policies and frameworks in place to facilitate that genuine inclusion and having that conversation of, okay, something bad happens. Who are the worst affected and the most vulnerable? How do we reach them? Okay, they're not part of the social protection system, so we need to go through another way, or we need to have them part of the social protection system. These are conversations that need to happen. Financing alone can incentivize that conversation, but it isn't sufficient for addressing these bigger issues that person raised. Thank you.
Thank you very much. Yeah, sorry, I'm just coordinating. We see there are some hands raised, I think, but we can't. I'll give it to you in a second, Babatunde, to also add your response. We see some hands raised. At the moment, we can't unmute you, but if you have questions amongst the attendees, please put them in the Q&A chat, and then we can address them and respond. But Babatunde, I think you wanted to add something.
Yes, I wanted to reinforce the point made by Shakira. I think ensuring an inclusive process has to be from the get-go, from the assessment phase. One, two, as you go through that process, of course, government has its own structures at different levels, all the way to the community, to be very intentional in involving every level of the governance process in designing and implementing both the immediate response interventions and the recovery interventions. What we did at the UN was to be very deliberate in ensuring that we created, because at the central level, of course, we have the UN Country Team Plus, which we call UNCT Plus, which includes NGOs and so on, national and international. But we then sort of federated that to the regions and the municipalities. So we created area-based coordination mechanisms that by design involve the local communities. And that way you ensure that the voices, the perspectives, and the needs of the local communities are fully reflected in the recovery efforts. Over.
Thank you very much. And I think in these responses, you partly also responded to one question that Vakti Al-Ktasi, sorry if I mispronounce your name, also posted in the chat. We don't have too much time, but we can unmute now. So I would ask you to stay brief. We have two hands raised. So over to you, Mohammed J, for a brief question, please. You should be able to unmute. If not, I see there's also another hand raised from Hamna Shakil Nagi. Can you unmute and post your question? Okay. If not, please put them in the chat, and then we can respond. We did have one other open questions. So the question was, given that UN partnerships rely on, in parts, I think we responded to, but given that UN partnerships rely on localization and local capacity building as two key pillars of sustainable recovery, how can innovative financing models be designed that enhance the role of municipalities and local communities while still ensuring effective private sector engagement, especially in environments with weak infrastructure and resources? And the example is mentioned, like the crisis-affected areas in Turkey. Are there successful mechanisms that have been implemented that can be built upon and replicated in similar contexts?
You're expecting me to respond, yeah?
Yeah, I mean, also maybe on the example of Turkey again, I think here we also have the it's again questioning how we can effectively involve the private sector engagement. So yeah, Kip, if you also have input on that one.
Yeah, very quickly, I think in terms of advancing recovery finance, from a UN perspective, what is required is really an integrated, anticipatory, and inclusive approach that starts right from the stage of disaster preparedness, response, and then long-term recovery. And that means that entails really complementary roles for governments, for the international financial institutions, the development banks, the private sectors, and of course the UN agencies. What the UN brings to the table is not money in this context. It's more about being able to bring together, midwife and facilitate those partnerships. And I gave the example of what we did with and continue to do with the UN Global Compact network in Turkey, which is very active. More than 400 large Turkish companies have signed up to UN Global Compact principles and were rapidly mobilized, of course, in partnership with the government to really fully participate, not just in the immediate response to the twin earthquakes, but also early recovery and continue to be actively involved. With the private sector, also, the UN has been very deliberate in making sure that they are part of the area-based coordination mechanisms that we have created that provides a structured way of always having the needs, perspectives, and concerns of local communities reflected in decisions that are taken, whether financial or infrastructural or that have to do with services and so on. So that's the way we've done it here and continue to do it here in Turkey. Over.
Thank you very much, and very conscious of time. So over to you, Kip, and then Sanjeev, before we close with a round of final points.
Thanks, Inja. Very, very quickly. So I think the example was given on Turkey, and I'll give another example in terms of working not only at the sovereign level, but looking at the municipal level. We have a program working with the UNDP in Argentina, where we're working with municipalities in that region and sort of the local sort of community to sort of develop flood products and flood contingency plans as part of our work that we have with under what we call the tripartite. And I think that's sort of an example that we, as private sector, we engage both at the national but also at the subnational level. So we're open to sort of the various modes of working. The problems are huge. They can be both sovereigns, but also can be sort of sub-sovereign. So just to highlight that this mechanisms not only operate at the sovereign level, but also can sort of go down to the subnational, but also even lower to the community level. So I think the schemes and the products and the modalities work all the same as Babatunde mentioned earlier. Thank you.
Thank you very much, and thanks for keeping it brief. Over to you, Sanjeev.
Thank you. I would just like to add on what Dr. Babatunde has mentioned of like inclusive recovery plan. So if you have an inclusive recovery plan involving the community at the ground level as well as the municipality, so this issue can be tackled. So in India, what with the recovery plan we follow is involving all the stakeholders, including the local self-government. And the focus is on the traditional knowledge, how you can utilize the traditional knowledge in building the recovery plan as well as mitigation plan, and by involving the community. This approach we followed in Nepal, earthquake of 2015. So when India provided assistance for building houses. So the approach was followed owner-driven approach, the training the local masons, so which helped in building resilient houses there in a resilient recovery. Thank you.
Thank you very much. And I would just a note that if we couldn't, we will look at the questions that couldn't be responded to and see if maybe we can still get back to you after the webinar. So we might not have been able to address all of them, but I want to close with a round asking all of the speakers if you would have one recommendation sort of to advance recovery financing, and also as we use this webinar sort of as a precursor for the technical session at the World Resilience Recovery Conference, what is the one recommendation you would want us to take away? And I'll start in the reverse order, so Kip first.
I think back to what I said, I think collaboration and open collaboration and not a fear of failure, I think are the key sort of constituents or ingredients that we need to sort of get this recoveries and recovery strategies to be more resilient and more available to all. So those are sort of the two ingredients that I will start and end with as well. Thank you.
Thank you very much. With that, over to you, Babatunde. What's your recommendation?
Basically, that recovery finance to really be a game changer has to be based on certain core principles. The first is integration. The second is anticipation, inclusion, and innovation. Over.
Thank you very much. Jaime, what is your recommendation?
Okay, my recommendation is the institutional framework. So in country like ours, where exposure to natural hazards is both structural and recurrent, being financially prepared shouldn't be a privilege, it's a necessity. That's why from the outset, it's become crucial to have predefined financial and institutional frameworks in place before a disaster occurs. So that's my very short recommendation. Thank you.
Thank you very much. Sanjeev.
Thank you. My recommendation is that each country, large or small, must develop its own system suited to its needs, and it must be nationally driven and some allocation of resources which are predetermined. Thank you.
Thank you very much. Last recommendation from Shakira.
Thanks, Tingsha. So my recommendation is the importance of focusing on outcomes. Why are we doing these things? Are they protecting the people we want them to protect? Just having financing or strategies in place are not enough. Just giving civil society the opportunity to contribute in planning is not enough. When disasters happen, are they being protected, and is that helping them avoid negative coping strategies? So outcomes and accountability. Thank you.
Thank you very much. So yeah, all the important points are there, open for collaboration, adhering to certain core principles to make this a game changer, looking at institutional frameworks. Of course, then it needs to be adapted strategies and systems from a national perspective. And lastly, importantly, focus on outcomes and what's actually the impact of the strategies that are implemented. Thank you very much to the speakers, and thanks for everyone to allowing us to adhere to the time frame. With that, I'm closing the webinar. The recording will be shared afterwards, and we have a last slide here on if you want to join some of the upcoming pre-webinars to the conference that are coming in May. Here you have the link where you can register and have the names. Thank you very much for joining us today, and have a good rest of the day.
Thank you, everyone.
Thanks.
Thank you.
Bye-bye.
Bye.